We're continuing to look at a Wacom Appliance and Furniture Supply. We are now going to look at 1C. And what's happened now is Wacom Appliance and Furniture Store or Supply needs some money. And they want to sell, or there's a couple ways you call it. They call it discounting. You're going to discount your note to a bank. You're going to factor it to a bank. You're going to sell it to a bank. These are all terms that can be used with regards to the note. But we're going to basically take this note and now we're going to sell it to a bank. Okay? And what will the bank receive if they buy it? Well, the bank's going to receive two things. The bank is going to receive $30,000. Plus, when the note matures, they'll receive the extra $1,200 for the interest. And again, I've duplicated some of the numbers from the earlier slide, so you can see I actually already calculated the $1,200. And this was from the first video we did with regard to Wacom Appliance and Furniture Supply. So they're going to receive a total of $31,200 is what the bank's going to receive. Okay, now the bank has a requirement for all notes that they factor, or all notes that they purchase. They require a 12% return on that note. Okay, well, 12%, and if we multiply that 12% times 5/12, and the 5/12 is the number of months that the bank is going to hold this, because Wacom Appliance and Furniture Supply is selling this note after 1 month. So they're going to hold it 1 month, then they're going to sell it, and then the bank is going to hold it for 5 months. So the bank, if they require 12%, they need to get a 5% discount on this. So applying the 5% discount here, the bank is willing, that's $1,560, I believe. So the bank is actually willing to pay for this note $29,640. And if they pay that today and hold it for 5 months, they will receive $31,200, which is an annualized rate of return of 12%. All right, so here are the journal entries when we originally purchased when we originally sold the stuff to the law firm, the furniture. Now we need to record the journal entry and the date of sale. So the first thing we're going to do is we're going to record the interest receivable of $200 and the interest revenue of $200. And we have held this note for a month. I mean, we are due the revenue from holding this note for 1 month. And so we're going to record that here first. And then we're going to record the actual sale of the note. Well, I know how much cash I'm going to debit because I just calculated it. It's $29,640. The entire note receivable is going to go away. And that entire note receivable is $30,000. I know the interest receivable is now going to go away, so that's going to be credited for $200. Now, to make this journal entry balance, I need to debit $560. And we're going to call this loss on sale of note. On note receivable. So this is a loss that would go on our financial statements. Okay, and so this is the journal entries then that are required for selling a note after 1 month to the bank. Okay, so let's run through this quickly again, and let's do it as if we're going to for 2 months. So what would happen? Well, again, the bank is going to receive the $31,200. They require 12% return on all their investments. Now, if we sell it to the bank after 2 months, they're going to be holding it 4 months. So the interest rate the bank is going to require is 4%. Okay, so we multiply the 31,200 by the 4%, and we get a number of $1,248. We subtract that from the 31,200, and we get a number of $29,952. And this is the amount the bank is willing to pay us on that note receivable. So if we had sold this to the bank after 2 months, September, October, on November 1st, the first thing we would do is we record our interest receivable of $400, because it is $200 a month, and record the interest revenue of $400. We are then going to record the actual sale. We're going to get cash from the bank, $29,952. We are going to get rid of the notes receivable. So we're going to, because we're selling it to the bank, it's no longer ours. So we're going to credit the note receivable for $30,000. We're going to credit the interest receivable because now everything is going to go directly to the bank. So we're not going to get that interest anymore. And we're going to then, to make this journal entry balance, I believe it is $448, and this is loss on sale of note receivable. So these are the journal entries that need to be made when we sell, factor, or discount, any one of those terms is okay, a note receivable to a bank.